Good morning, ladies and gentlemen. Today we're going to be talking about will he bling. We're going to be talking about Jerome Powell, CPI, giving you the key levels for today to watch out for, depending on how CPI just came in. Or if you guys have not seen, CPI was probably released 15 minutes ago if you're watching this video when it came out, or basically just at the start of the day, 8:30 today. So go on and link down in the description below to investing.com where you can actually see the schedule and basically see what it was expected to come in. But if you have not seen that, we're going to go to that real quick. So the CPI is expected to come in at 4.1%, which is an absolute mind-boggling drop. Now, why do I say it's mind-boggling? You had a 1% decrease and then you had a 0.1% decrease the following month. So the headline CPI number, the year-over-year number, is expected to be very volatile. However, oil and gas prices have basically stayed necessarily flat. I don't know how it is around your region, but just comparing two different regions of the country, I'm seeing prices basically kind of just fluctuating about 25 cents plus minus in each direction. But nothing really too crazy compared to the fluctuations we've seen earlier in the year. So CPI month over month, 0.2. They're expecting basically a 0.2 decrease from the previous month from 0.4. But core is basically staying flat on the month and slight decrease on the year. So it's a very peculiar number. And the question is, which number is the market going to run on? Are we going to get a bullish beat? Are we going to get a complete miss in the sense of going higher, having inflation stick around? And for trying to judge what the Fed is going to do, I would be looking at core CPI. Now, the market may have a totally different reaction. They may pick CPI and then just completely run on it. Be cautious, guys. I'm not here to tell you which way it's going to go. I can only give you the levels and see what the market's actually going to react and some of the scenarios that could play out. I'm seeing a couple peculiar things in the market that are very reminiscent of the big drop in 2008. Now, I'm not saying we're going to get the big drop, right? Guys, no, I'm not sensationalizing it that way. I'm saying the market is due for a pullback, and Jerome Powell could give you a spanking tomorrow coming into the FOMC meeting minutes. And could the market misconstrue what he's going to say and what he actually says? Remember, if we go to the Fed CME tool, we're basically pricing in an 80%. So 80% of traders will be caught off guard if CPI comes in hot. Now, to me, that's going to create a pretty massive correction in the market, and especially with today going into CPI, with the market running 1.69% on the NASDAQ, 0.91 on the S&P 500, 0.56 on the Dow, and the Russell following or lagging behind at 0.42. It's very reminiscent of a very risk-off mentality, or risk management, I should say, mentality of being off and just all in, markets only go up. And here's the thing, the market, when people get so off sides on a trade, case and point, it comes and takes your donation. So could the market be gearing up to take the bull's donation after it's been taking the bear's donation for so long? They've been capitulating, getting absolutely destroyed. Is it now time for the teeter-totter to swing the other way and maybe give some of the bulls a reminder that the market takes equally from everybody? Now, there is the famous phrase that when people are greedy, you should be fearful, and when people are fearful, you should be greedy. That is from Warren Buffett. He's been doing this longer than most of us have been alive, so I think we should listen to the man. And if we jump over to the Fear and Greed Index, we can see we ended in a resounding 78, extreme greed. Now, one of the peculiar things that I saw today was the put to call ratio. Now, we're going into OPEX this week, meaning there is a tremendous amount of options expiring on the indexes, and there is a lot of money to burn. Usually market makers don't like paying out one way or another, and just looking at it, there's more calls to burn than are puts. There's basically almost a 2-to-1 ratio of calls to puts, probably like a 1.8 roughly if I had to assume the call to put ratio. So for 1.8 calls for every one put, and that means there's a lot more money to burn on the bullish side. VIX has just been a dead dog, as I would say recently, but it's starting to come back to life, guys. So this is the thing that I say peculiar. Peculiar point number one. One actually was the Fear and Greed Index. Two is going to be VIX. So markets up, and VIX is up 8.54%. I thought that everything was fine, that there's complacency. Why are people buying protection if this is the start of the new bull market, if all-time highs are up ahead? Why are people buying protection if that big money, usually the big money is what buys VIX. This is like basically it's a cash settlement index, so you don't really have like retail traders buying this. It's usually big hedge funds, hedge fund managers, banks, stuff like that, that very large institutions buy VIX. Now, if I was not looking this as an index, what would I tell you? Just looking at the chart. Well, we have a possible MACD cross and RSI is crossing, trying to get over the 50. I think this is bullish. And here's the thing, me telling you VIX is bullish is not a good thing for the market. You do have a MACD divergence here on VIX, basically right here, coming back down from March, where we basically had a nice pump up in VIX, which was our March bounce. Then we continued, and here's the other thing. VIX bounced off a trend line. It held that trend line, bounced off of it, and here's the thing. When VIX gets down to these levels, the last time we were down at these levels is right before the 2020 COVID rip your face off VIX rally all the way to 84. Now, do I think we're going to get that? No, but here's the thing. Bad things happen when VIX spikes. Could VIX easily spike to the 20s where volatility would be increased in the market? And I think there could be a harsh reality check on the way. Now, if VIX basically continues to die off, that means that there's an extreme amount of complacency in the market, and we're just going to keep chugging along, right? So things are shaping up to be a little skeptical. And now, the other thing is, if we look at the S&P and we look at the volume, I keep going back to this, guys, just because the volume has been absolutely decreasing crap. You have larger red volume than you have green volume on the S&P. Today was not a high volume day. And the same thing with the NASDAQ. The NASDAQ has bigger red volume candles than there are green volume. Now, there's more green days in the market right now, but here's the thing. Why are we not seeing this large volume pushes? It's almost like sellers are absent. Why would sellers be absent? Have they completely given up? Well, why don't they capitulate? And that's where you get the high volume. When the sellers capitulate, when the shorts capitulate, you get that basic massive rally. Like if we go back to looking at basically January, like when we saw this dump here into January, this push off, look at the volume. The volume was absolutely massive. We're basically 2/3 of that volume. So we're not finding these high volume pushes, meaning anything of high volume on the way back down could basically show us coming back down to lows very quickly, sending through a lot of these price actions. And if you guys follow any volume profile trading, I'm going to dive into that real quick. And we're going to go to the S&P or ES, which is the futures. Now, today's rally, we basically closed outside value area high. That's basically value area high is where 68 high to low is 68% of the volume that's transacted throughout the day. And basically this last push, you completely, and I mean, there is little to no price structure. And what do I mean by price structure, guys? You see the blue and the yellow, that's buying and selling. So buying and selling, these are nodes. This is area where it's volume at a certain price. So think of the volume graph just inverted on the side, and you can see it for every single price versus the time. And this is very weak volume, meaning any price action that basically comes back to the downside, you're basically going to get an easy move down. That's what I'm saying. You're setting yourself up for a massive rip your face off bear rally, because it is not healthy. I want to be bullish on the market, guys. Like full transparency, I want to be bullish. But when I see several naked POCs are basically point of control, that where volume is very, very heavy, concentrated on the day, and usually they act like magnets. So if we zoom this basically out, I'm actually going to go to the 15-minute graph, and you can see, 1, 2, 3 now, naked POCs, 4 coming down here. So you got 4 POCs coming back down to these levels, and basically that means that you've not eliminated any of this price structure. There's a lot of price structure down here that you want to come retest. These are magnets. Think of your stacking magnets. You're stacking neodymium magnets, and then you're trying to hold a bar away from that magnet, and every time you stack a magnet, it becomes harder and harder and harder to get away from those, basically pull away from those magnets. Think of those white lines as the same thing along with the blue line. So you're creating a lot of price structure that you haven't really retested. Now, when we were coming back through this area here, right? So I'm going to zoom into this area here just to give you a perspective of what a healthy consolidation looks like. Now, even you see where we're taking out all the structure from the previous day or the 2 days before, there's no lines that are really, really long that are just basically going through an area to, you're hitting that area, taking that price point out, and then you're advancing. Either you're advancing to the upside or downside. Going this balloony bubble, as I call it, because these straight moves up without retest of the price is very, very concerning. Now, why is it concerning? Because when you come back down through this, especially on the weekly composite, which I can't show you guys just because I don't have it on this trading platform, I'm going to try figuring out how to do that for you. But the weekly composite has a gigantic hole in this area here that basically brings the ES down approximately from its current price all the way down 3.5%. So could you get a CPI disappointment or a Jerome Powell rip your face off Jackson Hole reminiscent? Because Jackson Hole happened around the same time last year, guys. So, you know, history doesn't repeat itself, but it rhymes. And for all those that didn't know what happened with Jackson Hole, the S&P basically had a very, very bad day during that time. If we go back to last August, this was the day right here. S&P fell approximately from the open to that day was about 4% in one day, and then continued to sell off an additional 4% before catching a bounce, which was later a dead cat bounce to the downside. So again, we're not seeing a lot of price structure. And now, what are the levels that basically we are going to be looking at? So if the market comes below 431.99, that's when I get bearish on it. That's when I basically be looking to ride to the downside or close out any positions. If you stay above 431.99, then I'd be looking to basically continue up higher, rip your face off, rally for the bulls to kill the bears. NASDAQ 357.66, right now you're at 360. And again, you basically had a big massive push towards the end of the day with very little price structure. So again, be very cautious. You did leave a gap down here on the chart. So it is very questionable of, is this rally going to continue, or are we going to start coming back and filling? Now, the point where you basically start breaking trend of the bullishness is the 346.51 on the NASDAQ and the 425.82 point on the S&P 500. Now, if we basically come back through those, you're looking at a 2-3% day on either of the indexes, which would be a pretty bloody day. Now, it could be an interesting buying opportunity, but I really would like to see this trend line here come retest and find a basically retracement. Like, I would love to see a 50% retracement of this massive move to the upside, which would bring us back down into the 421 on the S&P. Or on the NASDAQ, if we consider this latest push from the low right here as our buying point, then 50% retracement brings you back down to 338.40, which could set you up with a nice A to B pattern on the way up. But again, we have to see. I don't believe markets running like this is healthy in any way, shape, or form. I would definitely like to see a pullback. And the big question is Jerome Powell going to blink? Is he going to give you a hawkish speech, or is he going to give you a dovish speech? And we're going to be covering CPI tonight, guys. So make sure you join the live stream. We really would appreciate it. And if you found this video interesting, throw a like on the video or think about subscribing to the channel. We try to cover your requested tickers on Friday, along with doing tickers that you request or recommend during the week when we're basically lower on the news scale unless some major news event comes up. And we do a weekend deep dive. The weekend deep dive from this latest week will be in the link down below. So take a look at it, guys, and see what you think. Have a great night.